Breaking news! Landlords are cutting their rent prices to attract tenants to their vacant houses and apartments. This can have an interesting impact on the real estate market. We may see a drop in home prices and the cost of rent in the future. But did you catch wind of the wild news? 2024 is shaping up to be this decade's hottest year for building multifamily units. That's crazy. We haven't seen an influx like this in 4 decades. With all the new apartments popping up, it's going to result in increased supply, which could ultimately lead to lower rents. Sounds like good news for renters, right? However, this sudden uptick in supply could actually put some real estate investors in a bit of a bind. They may be forced to sell their properties, lowering home and apartment prices even further. Rental prices going down sounds like a good thing for renters, but it could actually negatively affect the market as a whole. Here's what I mean. If rents decrease, potential home buyers might hesitate to make the big move. Why? Well, if someone is currently renting a place and sees that they can keep their rent the same or even lower it, rather than buying and paying much more, they'll probably stick to renting. Why bother dealing with high mortgage rates and buying a house when they're content with their current living situation? Let me fill you in on the latest rental market trends. It's a bit of a mixed bag, to say the least. According to recent data, 71 out of the top 100 cities in the USA have experienced a decrease in rent growth over the past year, a whopping 70% of cities in decline. And before I reveal which cities are seeing the biggest rent drop, please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe is fuel for the algorithm that helps support this channel. Thank you. Now, back to what I was saying. The biggest rent drop can be found in cities like Austin, Phoenix, Vegas, Atlanta, San Francisco, Salt Lake, Orlando, Jacksonville, and Raleigh. These are the places where renters are seeing the most significant savings. On the other hand, there are cities where rents are still going up, like Hartford, Milwaukee, Chicago, Louisville, Kansas City, Providence, and Boston. It's clear that the rental market is evolving rapidly right now. Even with some cities experiencing increases, there are still many opportunities for renters across the majority of the country. You won't believe what the apartment developers in Nashville are up to. They're offering some insane leasing concessions that could get you 3 whole months of free rent. That's right, a 25% rent discount. Although these rent cuts may sound like a no-brainer, they could end up causing some issues for investors down the road. Combining falling rents and rising interest rates is not a good combination for landlords, especially for those on Wall Street. These guys look at their real estate investments by comparing the return they can get, called the cap rate, to a benchmark. Here's where things get tricky. For most of the past decade, the cap rate was way higher than the 10-year Treasury yield in America. But now, since these insane rent cuts have been introduced, investors might have a lower return than their benchmark. As a result, they could eventually be forced to sell off their properties. So, over the past year, the 10-year Treasury rate has climbed higher than the cap rate. Basically, this means that investors on Wall Street can make more money by investing in a 10-year government bond rather than buying properties and renting them out. Crazy, right? The result of this shift is that we're seeing a bit of a fire sale from Wall Street investors who previously owned property. They're starting to put their homes up for sale in markets like Phoenix. This could mean good news for first-time home buyers, but it's still too early to say for sure. I was reading up on CNBC, and they're reporting some pretty discouraging news about home sales. Apparently, they've taken a steep dive down to record low levels since the foreclosure crisis. Yikes. It seems like first-time home buyers aren't feeling very motivated to invest in the housing market right now. With rental prices dropping, it just doesn't make sense for them to take on the added expenses of buying a home. Plus, let's be real, buying a house is no joke, and it can cost a whole lot more in comparison to just shelling out rent money. It's a pretty intense situation, and it's definitely a bummer for those in the real estate industry. The current situation in the housing market pretty much has 2 possibilities. The first one is if home prices decrease, which would make it more affordable for first-time home buyers to get into the market. This would also create a profitable opportunity for investors since a decrease in home prices would cause the cap rate to increase, resulting in a better return over the 10-year Treasury. In simpler terms, it would make buying property more appealing again. Now, you might be wondering why home prices are so high in the first place. It's partly due to supply and demand. With a limited number of homes available on the market, the demand is high, which drives up the prices. Another factor is the cost of building materials, which has increased significantly over recent years. So, right now, the ideal situation for real estate investors is for prices to drop. This would cause the capitalization cap rate to rise, which means better returns on investment. However, if rents were to increase, that could also lead to a higher cap rate and make it more attractive for people to become investors or homeowners. Unfortunately, that's not what's happening right now. In fact, rents have decreased by an average of 1.2% year over year. This means that the incentives for becoming a homeowner or an investor are not as strong as they could be. Another important thing to note is that the inflation rate, as measured by the Consumer Price Index, is likely to decline in the future. This is important because the inflation rate for rent tends to lag behind the asking rent reported by Zillow. So, while rents are currently decreasing slightly on average across the US, it's possible that the inflation rate for rent could fall even further in the future. You may also have heard about the skyrocketing treasury yields. It seems like everyone's freaking out about inflation getting worse because of all the government bonds being issued, our deficits going up, and oil prices on the rise. And honestly, they're not wrong, but here's the thing. If we predict that rent will continue to go down in the CPI, that's a good sign for bringing down the overall inflation number. So what does that mean for us ordinary folks, especially those of us looking to buy a home? It implies that disinflationary forces are at work here. In plain words, that means we're seeing the effects of lower demand for rentals and homes. And that's definitely something to keep in mind when trying to project how the economy is going to behave. You must also know that mortgages on apartment buildings are quite different from residential mortgages. Yes, they usually last for only 5 to 10 years compared to the 30-year term for a residential mortgage. This means that apartment owners are constantly trying to refinance their properties, especially now that their interest rates are rising to 7% due to declining building values and rents. Experts now worry that this trend could cause a major issue in the commercial real estate sector, with many apartment landlords defaulting on their mortgages and giving back the keys. This, in turn, could further decrease the value of apartments, leading to even lower apartment rents. It's not all doom and gloom, though. Some investors may see potential in distressed apartments bought at discounts and take advantage of this by cutting rents to undercut the market and entice new tenants. However, this could also lead to an oversupply of apartments, driving rents down even further. Jerome Powell from the Federal Reserve is making some big news lately. He's saying that interest rates are going to stay high for longer than we might have expected. And on top of that, Powell's friend is coming through with some extra info. Inflation is way too high right now. This means we might need lower economic growth to get it back down to where we want it to be. Now, Powell's not just saying this stuff because he's bored. He's actually looking at some historical data that suggests we need to go through a period of below-trend growth to make sure our inflation stays at a steady and sustainable 2%. This means we might see some softer labor market conditions for a bit too. Why does Powell express such concern about inflation and economic growth? There are several factors at play here. Firstly, we have observed quite high numbers in terms of retail sales and initial unemployment claims. Normally, this might be considered a positive development. People are purchasing more goods and fewer individuals are unemployed. However, Powell is apprehensive that in this instance, these indicators are actually signals that the economy is becoming overly heated. And when the economy becomes too hot, well, that's bad news for everyone. The rental market is also taking a hit, which means that the Federal Reserve could be in some serious trouble. The problem is that interest rates and rental prices are going down, which isn't a great combo. It's like a weird mixture of hot and cold that has the potential to really mess things up for real estate investors. In fact, it's already causing the value of apartment buildings to plummet. It's a tough situation, and it's happening in real time. The Fed needs to do something fast before things get even worse. Thanks for watching, and please make sure you subscribe if you enjoyed the video, and be sure to leave a comment below, letting me know if you're also seeing rents go down in your neighborhood.